Claire Smith from Schroders, welcome to the Alternative Symposium.
Thanks for having me.
Can you expand on the investment universe of your private equity strategy?
Yeah, absolutely. So the strategy is 80% in the small to mid-cap buyout part of the market. So these are profitable companies, existing clients, and 60 to 70% of the deal flow in that part of the market are actually previously owned family-owned businesses, so might have been handed down a few generations. And then we have a 20% sleeve, which goes more towards the Asia growth part of the market, so more companies in their sort of development phase, and particularly we like Asia in that part of the market because we do see some good demographic trends and a little bit more optimism around GDP growth in Asia versus the Western world.
And do you utilise secondaries within the strategy? Could you expand on what they are?
Absolutely. So there's two types of secondaries. There's an LP sale, which is where if you have an investment in a fund and you need liquidity, you'll sell your holding to another investor. So we used to do quite a lot of that. We found that part of the market got quite overbid. So we've been shying away from that part of the market recently. And what we've been doing is a GP-led secondary, or often also called a continuation fund, where the manager will roll over 1, 2, 3, a few crown jewels of the fund into a new vehicle. And this is really to combat the effect that previously, you have a legal maturity of the fund, investors need their money back, so the only option was to sell often to a competitor. So private equity investors being very intelligent, created a mechanism to keep exposure to the company, and this can be particularly strong if they think there is a lot more growth to be captured from that company. But obviously a lot of work to do around the price that the company is crystallised at and the incentives for the both the investment team and the C-suite executives in that new vehicle.
And you run a multi-sector, more diversified strategy. What are the benefits of that over, say, a single fund allocation?
Yeah, well, I think the private equity universe is massive. We have a database of 10,000 private equity managers around the world. It's quite an opaque asset class. To find real track record data, you often have to have paid subscriptions to different, outlets. I think people are very smart at presenting their track record. There's the joke always top quartile. Everyone can find a way to show that they're top quartile. So we find that, the private equity universe being quite overwhelming, we've really tried to develop a sort of one-stop shop for private equity. So where you're diversified by sector, diversified by geography, diversified by manager. So we have tried to make what's sometimes a daunting asset class a little bit simpler by saying, well, even if you only make one to a handful of private equity allocations, this will offer you a broadly diversified suite of companies.
Does that help with things like vintages or vintage risk?
Yeah, absolutely. And I think the semi-liquid structure, which is, obviously a bit newer in the market, most funds have closed-end vintages. I love it as a lazy investor. As you're accepting new money into the fund, you're constantly making new investments. And I think it's been a big topic over the last sort of year. When's the bottom of the market? When should people, if they haven't made an investment, maybe they're looking at performance and thinking, oh, have I missed the boat? But we're getting, 20 to 30 mil of new flows into the fund every month, and they're being invested into new opportunities. And similarly, you're exiting existing investments that are creating more cash to reinvest. So I would say the fund basically averages in for you in a way. And, with that 3 to 5 year holding period, you should be turning over about 20% of the portfolio each year. You can also average in on top of that if you are quite, risk averse or want to do that. But what I quite like about the semi-liquid structure is it takes the headache out of timing investments, reinvesting, because the fund is continuously reinvesting new monies as it flows in, or exits as they exit companies is going to be invested into new companies as well.
There's been a lot of talk about valuations in recent months. How have they evolved over the last 12 months and where do you see them going over the next 12?
Yeah, so, we do have to reflect what's happened in listed markets and the way we value our companies. So with the sharp decline we saw, early stages of 2022, we've had to factor that into our exit assumptions for the companies we hold. So we value the companies with a mixture of, what are the kind of last 12 month sales and the outlook for the company. And then we look to listed markets for a proxy of what someone will pay for that company. So, there's lots of schools of thought around what's going to happen in the market this year. If listed markets fall again, we will have to factor that into our valuation technique, so we will fall. You do tend to get a more dilutive effect in private equity because of the illiquid nature we sort of predict an exit point and use a very high interest rate. So, you don't get a one-for-one movement with listed markets in that reduction. But absolutely, if listed markets come off, I think I heard the other day a 65% chance of recession. I don't know, don't ask me. But yeah, absolutely, if listed markets come off, we will have to reflect that into the company valuations. But meanwhile, our portfolio, the companies are performing well, sales have been up, quite conservatively geared, so we do feel, reasonably optimistic about the positioning of the fund.
And valuation's a bit more nuanced than just discount rates, aren't they?
Yes, yeah. So we run a lot of scenario analysis. So we have our high case, mid case and base case for every company within the portfolio that makes up more than 50 basis points of AUM. So we have to look at last 12 month sales, costs, projections around earnings, projections around exit points. And then, as I mentioned, we have to look to listed markets as a proxy in terms of, what they're trading at, as a proxy for what someone might buy this company at the point when we exit. So there's a whole heap of formulas. We use a whole bunch of different metrics and then probability weight them all and come up with a number that we think is the best and fairest value we can apply for that company at the end of the month. So I think there's been a few talks about, lagged NAVs or stale NAVs. Our fund is valued, every single month because we have investors coming in and they're buying in, and we have to try to give them as fair a valuation as possible.
Is there a growing risk of cash boxes impacting on longer term returns?
Like the cash within the fund?
Yeah.
Yeah, I mean, we hold 10 to 20% cash within the fund because we have that, people being able to withdraw on a quarterly basis. We have to have cash available for withdrawals. So we estimate the cash drag will be around 1 to 2% per annum. But, what I quite like about the semi-liquid fund is the cash drag is shown in the net returns you get to that investors receive. If you go into a closed-end fund, the manager will show you a lovely IRR, ignoring the fact that you've held some cash in your bank account, waiting for them to call capital, or they've returned capital and it's taken you a little while to reinvest that capital. So it is, it's a cost to having the semi-liquid structure, but that cost is shown in the net returns of the fund. And I think most investors, a 10-year lockup can feel pretty daunting, but a sort of, quarterly to 6 monthly lockup feels a little bit more comfortable. And I think most people, I personally would be willing to pay 1 to 2% for that little bit of comfort.
And which sectors and countries are you seeing the best opportunities at the moment?
Yeah, so in terms of sectors, we're a bit boring. I feel like I keep saying the same thing, but that's the that's the sort of way we run the strategy. So healthcare being very defensive, off the demographic trends of ageing population, people living longer. Western world's just spending more money on healthcare, so that's a long-term trend that we really like. In terms of geographies, we quite like Asia, particularly China and India, as a diversifier away from the Western world, because we do see Western world economies as pretty mature, expect a lot of natural GDP growth out of those regions. So we like to have that sort of Asia diversifier, and particularly in Asia, some of our most successful investments within the funds have been in the cyclical consumer space, which is not something we would do in the Western world. But there, we follow those demographic trends of the increasing wealth of the middle class, changing consumption patterns. There's a whole raft of millennials across Asia with cash to burn. So we quite like having that sort of, diversified portfolio that even if the Western world is a bit more stagnant, should see a bit more growth through Asia. If things go bad, we've got the defensive side of the healthcare consumer staples in Western world as well. So
Claire
all
Smith.
about diversification. Sorry.
That's all right. Claire Smith, thank you.
Yeah, thanks so much. Thanks, Drew.